This video is for educational and entertainment purposes only. This is not financial advice. I'm sharing publicly available data and my own analysis. Always do your own research before making any investment decisions. Investing in stocks involves substantial risk of loss, and past performance is no guarantee of future result. Do not invest in any stock just because it's trending online. SentinelOne just hit breakout status on Google Trends and YouTube searches in the United States. The stock popped nearly 9% in the last few days and closed at $14.35 on March 9. Wall Street's average price target is sitting between $20 and $21. That's roughly 46% upside from here. But the stock is still down almost 28% over the past year, and earnings drop in just 2 days on March 12. So today I'm giving you the complete no BS breakdown. The exact 5 reasons an investor might want to buy SentinelOne right now, and the 5 reasons you should probably stay away. Let's get into it. Quick company snapshot before we dive in. SentinelOne is an AI-native cybersecurity company that protects endpoints, cloud workloads, and now digital identity. As of the March 9 close, market cap is about $4.88 billion. The stock trades in a 52-week range of $12.24 to $21.40. Trailing 12-month revenue sits at $956 million, and they're guiding for $1.001 billion in fiscal 2026. That's 22% growth. Latest quarterly revenue came in at $259 million, up 23% year-over-year, with annual recurring revenue now at $1.06 billion. The company is still unprofitable, trailing EPS negative $1.26 and roughly $411 million in net losses last year, but those losses are narrowing. Let's start with the 5 reasons why an investor might seriously consider adding SentinelOne to their portfolio. Reason number 1. Explosive market opportunity and solid growth. Cybersecurity spending is exploding thanks to AI-powered threats and rising geopolitical risk. SentinelOne is delivering consistent 20 to 23% revenue growth in a massive total addressable market. They're on track to cross the $1 billion revenue mark this year with $1.06 billion in locked-in annual recurring revenue. That kind of durable growth matters when every company on the planet is worried about getting hacked. Reason number 2. Real AI advantage and a fresh product catalyst. Unlike older cybersecurity platforms that were bolted onto AI later, SentinelOne was built AI native from day one. They just launched a major new identity security product that's already getting strong early traction. Customer satisfaction scores are extremely high, in the 98% range, and they're winning new logos while expanding deals with existing customers. In a world where identity theft and credential attacks are skyrocketing, this timing is perfect. Reason number 3. Extremely attractive valuation. Here's the standout point. SentinelOne currently trades at only about 4.85 times sales. Compare that to its biggest rival CrowdStrike, which trades north of 20 times sales. This is one of the cheapest high-growth cybersecurity names available right now. When you get strong growth at a discount like this, the margin of safety is meaningful. Reason number 4. Strong analyst support and multiple near-term catalysts. 28 analysts currently rate the stock moderate buy with that $20 to $21 average price target we mentioned, 46% potential upside. We also have earnings in 48 hours, continued institutional buying, and real tailwinds from global cyber fears. Timing is on the side of anyone who's been watching this name. Reason number 5. A clear path to profitability. Losses are shrinking quarter after quarter. The company is guiding for continued margin improvement, and they're on track to reach sustainable profitable growth at scale. If execution stays on point, this stock has legitimate multi-bagger potential over the next 3 to 5 years for investors who can handle the volatility. Those are the 5 bullish arguments. Now let's flip the script and look at the 5 reasons you might want to stay away. Reason number 1: to be cautious. The company is still deeply unprofitable. Trailing EPS is negative $1.26, and they lost roughly $411 million last year. Yes, losses are narrowing, but they're still burning cash and have not yet reached consistent profitability. That's a real risk factor. Reason number 2: brutal competition. CrowdStrike has significantly more scale, brand power, and market share. SentinelOne is the leaner, cheaper challenger, but when Fortune 500 companies are choosing a cybersecurity platform, the established leader often wins the biggest and most profitable contracts. Reason number 3: growth is slowing. The company used to grow 30% plus in earlier years. Now guidance is 20 to 22%. Any miss on the March 12 earnings call or future guidance could cause the stock to drop sharply. Reason number 4: high volatility and macro sensitivity. This stock is already down 28% over the past year, and it moves wildly on any sign of slower IT spending or disappointing result. In a market where interest rates or economic data shift quickly, cybersecurity names like this can get punished hard. Reason number 5: execution risks ahead. The company just announced a new CFO starting March 24. Any hiccup in integration, combined with a growth miss on earnings, could create short-term pain. Remember, cheap valuation only stays cheap if the business keeps delivering. So here's the bottom line. SentinelOne has real AI momentum, attractive valuation, and strong growth in a massive market. But it's still losing money, faces fierce competition, and carries meaningful execution and volatility risk. Earnings on March 12 will likely decide the next big move. Drop your take in the comments. Are you leaning toward buying the dip or staying on the sidelines? If you found this analysis helpful, subscribe and turn on notifications. Thanks for watching. See you in the next one.